The Bank of England will on Thursday announce its latest monetary policy thinking. With me to discuss this is John Wraith, strategist at UBS. John, the backdrop to this meeting is higher growth, but at the same time higher inflation. So that presents a balancing problem for the bank?
Yeah, and it has done a few times over the last 6 months or so. They were expecting inflation to pick up, primarily because of the weakness of sterling over the past year or so. The growth picture has surprised them to the upside. It's been significantly more robust than they expected, at least into the end of 2016, and that's something that they'll have to acknowledge later this week.
And the other backdrop is the indicators that are showing declining confidence. Is that, first of all, with investors?
This is the balance that they're trying to strike. They can see that the current situation is quite strong, but they see some of these indicators which I think give them pause for thought. This is a series actually prepared by their own agents, so they put a lot of weight on this. And what you can see, this measures investment intentions in manufacturing and services. We're not anywhere like as bad as we were back at the time of the financial crisis, but you can see over recent months a fading of strength here, which is a good leading indicator that suggests companies may start to act more defensively going forward.
Now, consumers were supporting the economy after Brexit, but are they starting to fade as well?
Not in the sort of empirical data, but again, we can see signs in this index of consumer confidence that all maybe is not well and that people are somewhat worried about the outlook. Again, the same pattern, nothing like as bad as things felt 8 years or so ago during the crisis, but clear signs over the last 6 months or so that consumer confidence is starting to wane. So as inflation picks up, potentially squeezes real earnings, and we get into the uncertainty of the EU exit process, consumers are suggesting they may become more defensive.
So that might point to easier conditions, but the quandary for the bank, as you point out this week, is that monetary conditions are tightening.
Well, we've seen it everywhere, partly because of the strength of growth, because of issues around the new US president and the possibility of a significant reflation on the fiscal side there. If you go back, this was the time of the EU referendum. These lines indicate implied tightening or loosening of interest rates in the UK. So after the referendum, essentially there was nothing priced in over about the next 3 or 4 years. Recently, we've seen this rise in expectations, so that now we've got about 75 basis points or 3 full rate hikes priced in over the next 3 years, even in the context of the EU exit process. That's a lot of tightening.
The elephant in the room, obviously, is Brexit, and the big investor concern, isn't it, John, is the extent to which the economy's dependence on financial services is going to be the big problem.
That's one element of it, certainly. You can see here the yellow line shows you how services continues to grow as a proportion of the UK economy. The dark blue area is financial services within that. So clearly a very key industry, as we all know. And as these EU exit negotiations unfold, it may be that the ability of the UK to host the financial system as it does at the moment will be challenged. That would suggest this share will fall away and that there are downside risks to UK growth from that.
And that is going to contribute to a weakening in sterling?
A variety of all of these factors, in our view: a weaker consumer, a weaker business investment, possibly a weaker labour market, and yes, big questions around the way that UK PLC can operate going forward in EU markets that will only become clear over time, are all dilemmas that we think will weigh on sterling and reduce those implied interest rate tightening expectations.
John Wraith, thank you very much.
Thank you.